Welcome back. In our top business story, Chinese Premier Wen Jiabao will visit the UAE, Saudi Arabia and Qatar from Saturday onwards and attend the World Future Energy Summit in Abu Dhabi, the Chinese Foreign Ministry announced. The brief announcement from the ministry said Wen will meet leaders from the three countries to, quote, thoroughly exchange views on developing bilateral relations and on international and regional issues of common concern. The UAE has been ranked by Forbes as the second best Arab economy, just behind Saudi Arabia, due to high oil prices, which have spurred infrastructure spending. The Forbes Middle East Study 2011, in cooperation with the International Monetary Fund, revealed that behind Saudi Arabia and the UAE, Qatar came in third place, Oman in fourth, and Kuwait in fifth. The results show that these countries have taken advantage of the recent higher oil prices by investing revenues in sectors such as health and education, as well as raising people's living standards through an increase in wages. US Futures Exchange Group CME is set to increase its stake in the Dubai Mercantile Exchange, according to press reports, quoting the chairman of the DME, Ahmed Sharaf. Dubai's energy-focused commodities exchange, home to the world's third crude benchmark, plans to raise money by offering more shares to its existing investors this year, Sharaf said yesterday. The shareholders will remain the same. Together with the CME, they include a Dubai Investment Fund and the State of Oman. Only the size of their stakes will change, he added. Sharaf, however, didn't say how large the capital increase would be. And let's now look at the stock indices across the GCC. China's exports and imports grew at their slowest pace in more than 2 years last month due to weaker foreign and domestic demand. We talk about this further with Timothy Fox, Chief Economist at Emirates NBD. Welcome.
Thank you.
Hi, Tim. Now tell us, these trade figures from today, do they signal a hard landing for the Chinese economy?
Well, I think on their own, 1 month's data never gives you that kind of indication necessarily. The trade figures were disappointing. In particular, import figures were very much sharply lower in December from November. They fell from over 20% year-on-year growth to just over 11% year-on-year growth. So domestic demand, import growth was very, very weak. Export growth fell as well, but not by as much. So actually the trade balance, the trade surplus rose. And the way in which growth is, or GDP growth is computed, it might suggest actually that these figures may be a slight positive for growth estimates for Q4. The other data we've been seeing from China recently has also shown a slight improvement in manufacturing activity and a bigger one in service sector activity for the month of December. So I think the data from China has been quite mixed, and for the time being it probably doesn't suggest a hard landing. It's more likely to be a soft landing.
Even though it's a soft landing that you're expecting, will we see further monetary easing?
Well, we've seen inflation data fall from a high point of around 6.5% in the middle of 2011 to just over 4% towards the end of 2011. We have inflation data later this week which should show a further decline in inflation, and that should allow the central bank, if it is concerned about slower growth, to ease monetary policy further through reductions in bank reserve requirements, the amount that banks have to hold in their on the balance sheets, and in order for that to, if they were to do that, then that would be tantamount to an easing in monetary policy. I suspect that is quite likely over coming weeks and months.